Good morning, guys. Today we will discuss one very interesting thing about stock as an asset class. So there are I will discuss stocks as an asset class as opposed to gold or bond or say real estate or FD. Why compared to these mentioned asset classes, stock shows higher volatility and uh, also higher return as well. So first of all, what is stock? Stock is just a share or ownership of a company. So in the longer term, what happens is the much that much you can get appreciation in your asset price in stock, only that much what the company will grow in that period. So but why the volatility? The question is why the volatility? When you see the real estate, for example, there you will see an intelligent buyer facing an intelligent seller. When one goes to buy a real estate, he or she will try to get as much of information as possible about that particular real estate, and he or she will come up with the what is called a fair price, what the other price or the other people also will agree with. But in the stock market, what happens is there is all types of people. There are all types of people who are transacting in the stock. Say someone who has zero idea about that particular company or stock, and someone who has all the idea about the stock, and someone who is in between. So in that case, what happens is there is abnormal transactions also happens, because what happens is when one does not have any idea of the stock, he or she may get fearful in the downtrend and exit from the stock at a very cheap price or discounted price. So there is one example. Say it is said that if there is a company who has a say only who has a who is listed in the index, sorry, who is listed in the exchange, and it has only one asset. Say it has a big building in the capital Delhi, and it is listed in the stock exchange. So as a when one goes to buy that real estate from the owner or company directly, he or she will have all the information about the particular place, how the prices are, and what price he or she should pay to the company to buy that real estate. But from the exchange, when the trading take place, what happens is not all the people who is looking at the stock knows about the company and what underlying asset it has. So they will give value to the company as per their own wishes and judgment. So say if the fair price is 100, you may expect a volatility of say 70 to 130 in the stock price transaction in the exchange of that building. Whereas if you go to buy that building directly from the company, maybe 5% will be maximum say 95 to 105, what the prices may vary. This is what happens in the stock market, because it is volatile in both the direction. So with higher volatility comes with higher yields also. So now the question is, why it gives higher return in the longer term. So what happens is, stock has an underlying asset, which is the company. What happens is, in the business, the company may be able to generate more than 15% return, which is not possible in any other asset, because if it were possible in any other asset, people would have left businesses and buy, say, gold. If gold would have given more than 15% return over longer term, and people would have sold the shares and sold the businesses and go to buy bonds and golds, FD, and real estate, because these are the asset classes except stock. These are asset classes which does not produce anything. Gold will be there in the house, shining all the time, and won't produce anything. It will just give artificial feel good to everyone, that he or she has a very attractive thing in her or his house. And about real estate, it will give the it won't generate much return in the longer term, in the same way one business does. So this is why the businesses can generate more return as compared to other asset classes. That is why the stock as an asset class would give higher return in the longer term as compared to the rest of all the assets. So I think this is very clear, guys. Thank you for watching, and we'll see you guys in the next video. Thank you.